Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Now, it's also important to understand where prices have turned in the past, okay? Because markets tend to peak and bottom near places where they have turned in the past. Stage 1 accumulations have lows that are very close to areas of past price support. And it could be long periods of time like that British pound chart where we actually keep bottoming every time we get close to 140. That goes back many years. And our tops usually happen near prior areas of price resistance, closer to where prices have turned in the past too. All right. Now, new trading ranges tend to form near these prior tops and bottoms, which could either lead to a distribution phase if price closes below the lows of the trading range. And this is the really important part. I'm not going to predict, and I don't have a good track record of ever predicting that that's going to happen. But I can react. If price happens to close below this new trading range after a big move up in price, I can say, okay, this can be a brand new stage 4 decline phase, and I need to switch up from buying pullbacks in an uptrend to shorting rallies in a downtrend. However, if price breaks out through the top of that trading range and goes on to make new highs, that is what we call a higher accumulation phase followed by a new leg up. So I want to show you the first chart that we're looking at here, the dollar index, the dollar futures contract from 1999 to 10/21 of 09. And we have a secular bear market happening here. We have a nice big long downtrend that we've been in. However, we also have a cyclical bull market in a secular bear market. We had this period. Now, this is a monthly chart, so it's important to understand that the time frames you're looking at, each one of these candles here is a whole month. And we also have two areas where I've marked off here, resistance from the year 2006 right here, and we also have an area of support down here from 2008. I marked these areas off because both of these areas were where prices ended up turning. Up here at the top, we actually rallied up into this resistance from 2006 between 90 and 94. And we had several months here, including the months of the financial crisis, to where we rallied into this resistance. And every time we did, that's where the top of this market actually happened in this little stage 4 pattern that you see here. Accumulation, followed by a markup, followed by a distribution, followed by a markdown. So we had this little 4-stage cycle here play out very close to prior turning points in the market. Resistance from 2006 and support down here from 2008. Okay, and that's the dollar futures contract. So support happens at places where prices have turned in the past. Buyers step into the market thinking that prices are undervalued, and they step in and they buy, expecting prices to turn higher. And buyers have memory. Sometimes they buy at a certain price, and if the trade goes in their favor, they remember that price, and they say, if price ever comes back there, I'm going to buy that asset again. And sometimes sellers who were short the market also decide that, well, this trade didn't work out so well for me. Here I have a chance to get out of this trade close to even, so they end up covering their short positions, and a lot of times that puts buying pressure in the market. And resistance, of course, is created at price levels where sellers come into the market in the past thinking the asset's overvalued, and they start to sell, which causes prices to turn lower. And again, if sellers were successful selling an area, they may sell again when price comes back there. And buyers who were long and wrong at the time may decide that, well, let me get out of this trade with a small loss. Mostly what they do that, it's to try to save themselves some pride. And I can give you an example. I happen to know still to this day people that are long Cisco systems from $80 from the bear market of 2000, waiting for Cisco to get back to 80 so they can get out even. So it's I'm not one of them, by the way, but I happen to know people who are like that. So once again now, trends, very important that we understand that there's different types of trends. There's trends inside of trends. As I've just mentioned, we have secular trends, which contain several cyclical trends in the opposite direction. So during these cyclical trends, we can have something called a primary trend, which is usually influenced by the economic or business cycle. And we kind of watch that on the higher time frame charts, weekly, daily, monthly charts, for example. Then we'll have what we call an intermediate term trend, which is a profit-taking move counter to the primary trend. A lot of times people will say that prices have gotten ahead of themselves in an uptrend, and so there will be a little sell-off. We recently had a 10% pullback in the Dow Jones Industrial Average in February, for example, and then broke out to new highs after that. So that would be called the intermediate term trend. And then, of course, the short-term trends are just little fluctuations, random reactions to economic data reports that get released during the month. And a lot of times these little gyrations will be great opportunities to trade if you understand volatility. And you can trade them on very, very small time frame charts. And you can try to react to that volatility and try to make short-term profits. Okay. So once again, on this particular chart, a visualization of these four stages: accumulation stage, okay, followed by a stage 2 uptrend. And we also have intermediate term trends during this stage 2 uptrend. We have several of them here where we have little retracements. We pull back to a trend line here. And during this uptrend that we have here, these are called the intermediate term trend, or counter to the primary trend, or down. Up at the top here we have a distribution where we go sideways inside of a channel once again. And of course this could break out to the upside. It's no question that prices could continue higher. It's only after they actually do close here below this low to where we understand that we have something called a distribution phase. And at this point in time, of course, if this happens, most everybody's going to be bullish on the stock, bullish on the market. The news is all going to be good. The pros, of course, are going to be taking their profits and probably initiating short positions. And every one of these little counter trend rallies that we have here, you'll find that the buyers will be jumping on these counter trend rallies, and what they're trying to do now is actually pick bottoms. And of course, every time that happens, the market goes on to make new lows and traps these people, and eventually some of them get panicked out, or they get margin calls and they get forced out. And so as you can see here in the uptrend, when we have these pullbacks, we have the market has gotten ahead of itself. It's ahead of the fundamentals. It shouldn't be doing this. And so everybody doubts the uptrend. And over here, this pullback is a buying opportunity, is what you'll hear everybody call. And unfortunately, if it is a stage 4 decline, it's not. And you shouldn't be buying these. Or if you are, you should be taking your profits pretty quick. So the dollar index is a basket of 6 currencies, which is the euro, the British pound, the Canadian dollar, Swiss franc, the Swedish krona, and the Japanese yen. The index was created in 1971 when the USA went off the gold standard. The largest component of it is the euro. And the ISE FX indexes allow you to trade each piece of this basket separately, which is great. The percentages here are mostly euro. 57.6% of the basket is the euro. The British pound is about 11.9%. The Canadian dollar about 9.1%. The Swiss franc 3.6%. The Swedish krona is 4.2%. And of course the Japanese yen is 13.6% of the basket.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.